Good afternoon, everyone. I'm Kerry Bayliss, Vice President of Strategic Business Development and Investor Relations here at Barita, and I'll also be your moderator for today's session. So to those of you who are joining us for the first time, a very warm welcome. And to those of you, our stakeholders who regularly join us, a very warm welcome back. We're really happy to have you this afternoon for another staging of the Barita Beat, where we get to provide you with an in-depth review of our financial performance and, of course, take the opportunity to engage directly with you. Now, Barita ended its 2023 to 2024 financial year on September 30th. So on the agenda today will be a presentation of our fourth quarter results and the factors that contributed to positive growth in our earnings. We'll then move to a business review, and we'll discuss operations, market conditions, and key strategic initiatives. Now, joining me today to take us through these presentations is our Chief Executive Officer, Ramon Small-Ferguson. Ramon also serves as Managing Director for Barita Unit Trust Management Company Limited. Also with us is Dane Broadbow, Chief Executive Officer, Designate, Financial Holding Company, and Acting Chief Executive Officer for the Cornerstone Trust and Merchant Bank. I have to take a little breath after that long title and introduction for Dane. And finally, but certainly not least, is Stephen Philibert, who is our Chief Financial Officer. Now, this earnings call is, of course, our opportunity to share our results with you, but it's also an opportunity for us to get to interact directly with you, our valued stakeholders. We want to hear from you. So as we go along, I'm going to ask that you submit your questions into the Q&A section that you see on the screen. And once the presentations have concluded, we will open for a Q&A section. So without further ado, I'll hand over to Stephen, who will take us through the financials.
Thank you very much, Kerry. Good afternoon, ladies and gentlemen. We will be starting on the operating income slide. So we see here that net operating revenue increased by 10% to $10 billion from $9.1 billion in the prior year. So that's up $901 million. As we look to the components of that, we see in net interest income a continuation of the increase that we've been signaling for some time now, and we started to see in the most recent quarters. So net interest income is being improved by changes in the economic environment as the tightness of monetary policy is relaxing and interest rates have started to decline. Fees and commissions is up to $3.7 billion from $3.4, so up about $305 million or 9%. And the increase there is primarily driven by a better outturn in investment banking fees, something we're very proud about. It's an area of the business that we've placed a great deal of focus on growing. And then gain on investment activities is up by a little over $500 million or 12% to $4.9 billion from $4.4 in the prior year. Now here we have gains on our alternative investments in both years, but we did have a smaller gain in that category in 2024 as opposed to 2023. And again, this is something that we've been signaling for some time now, that we expect to see those gains trending off as it relates to valuation changes, and then they will convert over time as we take up the development stage of those assets. It will turn to harder earnings from those development activities. So what we do have that is larger in the current year relative to the prior in relation to the gain on investment activities is significant increases in valuations for both fixed income and equities securities. Those are both reflecting the improved economic environment. Turning to expenses, operating expenses are up to $4.85 billion relative to $4.6 in the prior year, so that's up about 5%. And again, looking at the components of it, we see staff costs continue to experience a trend downwards year over year. We have explained this in recent quarters as well. This is as arising from our retrenchment activities that took place roughly a year ago, coming up on a year now. So those continue to reflect benefits in terms of a lower cost structure from staff costs going forward. So it's 3% down, just under 50 million to rounded to 1.7 billion. Administration costs decreased by 221 million, or about 8% to 2.7 billion from about 2.9. Here, the major impact arises from different treatment to expenditures related to the implementation of our new core system. And I should just spend a moment explaining why those changes arise. So at one point, at the earlier stages in the project, we had been undertaking that project as a software as a service exercise, which lends itself to expensing those costs that arise from the project. In fact, that's what's required under the accounting standards. As it is now, the project is an on-prem, meaning that you have an installation of the software actually on your premises, and the accounting treatment for that is different. It requires you to capitalize much of that expenditure, and so it reflects a shift there from expensing to capitalizing those expenditures. And finally, in the impairment/ECL line, we see 510 million in current year expenses relative to a very small write back of about 4 million in the prior year. And this is just us applying prudent provisioning to securities where we're perceiving an adverse impact or adverse signs with respect to those securities. So the outcome of that is that our efficiency ratio has improved to 49% from 51% in the prior year. So to summarize on this slide at the net profit level, and then looking at some of the main balance sheet items, net profit after tax for the full year is 3.88 billion relative to the 3.41 in the prior year. That's about 14% up. And similarly, that 14% increase reflects in our earnings per share at about $3.24 relative to $2.85 in the prior year. Balance sheet metrics, the size of the balance sheet, the total assets, has increased by about 11% to 142.8 billion from 128.2 as at the end of the prior year. The largest component of that, as always, is the securities portfolio, which comprises of two lines, primarily the pledged assets and the marketable securities lines. Those total now to 107.1 billion relative to 104.7 in the prior year. Not a large percentage change, about 2%. We see where there is a larger percentage-wise change in the loan portfolio up to 12.3 billion from 10.9. That's about 13%. And then on the funding side, total liabilities is up about 16% to 107.3 billion from 92.8. The largest component of that is repurchase agreement liabilities, which are up to 81.7 billion from 75.4. That's about 8%. Secured investment notes continue to decline. Those have been trending downwards for some time now, to about 3.5 billion from 5.9. That's down 41% year over year. And then other debt facilities is at 13.9 billion relative to 8.3 in the prior year. And the biggest component of that change, that increase for that line item, is the issue of bonds, which was done during the period. Shareholders' equity is roughly flat. I just want to correct that 2% figure in the change column. It's actually 0.2%, so it should have been rounded to zero. It's roughly flat at 35.45 billion relative to 35.39 in the prior year. Capital adequacy continues to be very strong and materially above the industry average. We're sitting at 25.5%. The industry average is sitting at 21.2%. And as always, this is relative to the FSC's minimum of 10%. So let's recap some of the highlights. 10 billion in operating revenue and net profits of 3.9 billion. Total assets of 142.8 and shareholders' equity of 35.5 billion. Efficiency ratio sits at 49%, down from the 51% in the prior year. And ROE and leverage figures are 10.9% and 3.8 times, respectively. So with that, I'll hand over to Ramon, who will walk us through his part of the presentation.
Thank you very much, Stephen. Good afternoon, everyone. As usual, I'm excited to be here to talk to you about our company, and to my fellow shareholders and to our customers, well-wishers, and other stakeholders. So my part of the conversation today, as usual, is going to focus initially on the operating environment, and then we're going to shift into some specifics about our strategy and how both correlate and how both would have correlated in generating the outturn that Stephen would have just mentioned. So if we look at the indicators on screen, what we're seeing is a bit of red. From an economic growth perspective, the outlook, both locally and globally, has been revised lower. Inflation, on the other hand, which, as I think most would be aware, has been the bane of most central bankers' existence over the last 2 years or so in the economic cycle, has continued to trend down. Right? And the underlying factors with respect to these two areas remain pretty much the same as the previous quarter. Locally, we would have had headwinds with respect to economic growth, primarily related to climate-related matters. We would have experienced in July heavy rains and wind associated with Hurricane Beryl, and in Hurricane Beryl's wake, Jamaica would have continued to experience inclement weather, which undoubtedly has impacted very broadly most industries that constitute our GDP. Right? Globally, there have been revisions lower with respect to growth in both developed and developing countries. There has been major geopolitical events either occurring or on the horizon, which bring with them uncertainty and generally tend to stymie business investment. And consequently, we're seeing where growth expectations have abated. So just to seems I have jumped ahead. All right, great. Back on track. So just to speak a bit, as per usual, about the vectors of our performance. Right, and there are a few. The first, as Stephen would have alluded to in speaking to the outcomes, and I'm going to talk about the inputs a bit, is a focus on revenue diversification and what we have described as balance sheet optimization. Right? I'm going to speak about this a little. So our business post-acquisition in 2018 has generally been very focused on a few things. The first is that we would have gone about a serial capital raising effort between 2019 and 2021 to really enhance the company's capacity broadly to withstand shocks and to take advantage of opportunities. Right? We have complemented that with infusing significant human capital into the business. And we have also spent a lot of time engaging existing and prospective customers. Right? Now, that has brought with it significant growth across all areas of the business. And we're now at a stage where we are focusing on continuing to grow, but continuing to grow in very deliberate ways and very deliberate areas of the business. So as this describes, we're optimizing our business lines, our balance sheet, and we're focused on diversifying our revenue. That works very well in this evolving monetary policy environment where we're shifting from a very tight monetary policy stance, both globally and locally, to one that's less tight and more accommodative. Right? We continue to rest heavily on that robust capital base, which was the result of that serial capital raising, right? And what that brings with it is flexibility, financial flexibility, as we like to say, and strategic flexibility, right? So prudent capital management is another pillar of our performance. Again, that allows us to absorb shocks and take advantage of opportunities regardless of the market environment. The third vector of our performance is a focus on operational efficiency and excellence, right? And the main source of that that we've been working through over the last 6 quarters or so is through specific integration efforts as Barita moved towards being a part of a financial holding company type structure. Right? So we're optimizing on the operating efficiency side. So the outcomes, as Stephen would have mentioned broadly, we're seeing now a recovery in traditional areas of revenue. So our net interest income, for example, our investment gains have remained strong, albeit they're now more diverse. So Stephen mentioned a decline in the level of gains from alternative investment exposures, but he also mentioned a sharp rise in the level of gains from bond trading and from our equity portfolio management as well. And finally, we expect the evolving monetary policy environment, all else being equal, to be a tailwind to our performance as we move forward. So what's our approach? Let me talk a bit about the tactical approach that we will be pursuing. So the backdrop is that evolving monetary policy environment, but it's complemented by subdued yet steady long-term growth expectations, both in Jamaica and globally, right? And for us, revenue diversification continues to be at the heart of our strategic impetus over the next several quarters. We're complementing that by maintaining flexibility. We want to execute what we describe as market neutral investment strategies that are agnostic to market direction and that allow us to perform at least modestly well, regardless of how things are going. That cost efficiency that we mentioned, now that we have achieved some significant degree of scale, it's important for us to continue to seek to engineer value through figuring out how we can do more with the same and also how we can improve the quality of our output and our efforts. So let me remind you about our key business lines. Investment banking is one, and Stephen mentioned that, something that we're pretty proud of. We would have started the investment banking business at the end of 2018. And since then, we have raised over 135 billion Jamaican dollars equivalent for clients, right, in that period of time. So we're coming up on 6 years now. Not bad, particularly considering the operating environment, which was characterized by a pandemic and all the post-pandemic effects, right? Alternative investments business line, which really focuses on our origination of exposures primarily in the real estate, private credit, and private equity asset class. That's another business line for us. Our asset management business, which, as the name implies, involves the management of client-related portfolios, whether it's unit trust, pension fund, other managed portfolios. And finally, our treasury trading and brokerage line, which deals with everything associated with our proprietary investment portfolio, as well as our client brokerage business. That's covered here. Also, our FX business is covered in this business line. So with that, I think we're now at the stage where I'll hand over to Dane, who's going to talk a little bit about the group and activities there too.
All right. Thanks, Raman. So, as we talk about Barita in the context of the group, so the first thing I'll talk about is our reorganization. So we're far advanced in our preparation, and we expect to have our shareholder meetings early in calendar year 2025, and we look to complete the reorganization early in that year. Now, again, the structure of the financial group immediately following the reorganization will see the securities dealer and the merchant bank being subsidiaries of a single financial holding company, and we soon become clear after we speak in generic terms. So, as we telegraphed before, we expect that the reorganization is going to unlock significant benefits for the group and enable elements of our group strategy that really reverberate throughout our subsidiaries, including Barita, primarily in terms of customer centricity and efficiency. Customer centricity as we organize our group around our customer and look to have our clients have full seamless access to the relevant capabilities of the group, and look to curate specific customer experiences and standards for our various segments. And of course, efficiency, as we look to streamline units, streamline processes, and optimize the delivery of our service to clients for operational efficiency, and unify best practices across the group for operational excellence. Now, our strategic ideals are built on a similarly deliberate foundation of risk, governance, and controls. So we're going to continue our focus on risk ownership at the first line of defense and the permeation of that risk culture through risk owners in the organization. Of course, while achieving the ideals of our group structure in optimizing the efficiency of our governance processes and maintaining positive client experiences as we manage our risks and ensure that we're compliant with regulation. Now, as we organize externally and internally, we expect to be structured to adapt to the natural group-wide view of the imminent Twin Peaks regulatory model. So, with our strategic plans fresh, there's active ownership of the risks that are relevant to that strategy. Now, so our risk management framework is the foundation of course, not only our operational resilience, but importantly also our financial resilience. So, our financial resilience, really our ability to withstand shocks, would have been demonstrated as market conditions would have gotten difficult and would have needed a strong buffer to absorb the shocks associated with falling asset prices. Our capital also enabled our alternative investment strategy, which had the benefit of giving resilience to our earnings, supplementing the reduction in more traditional sources of revenue during that same era of rising rates. And it would have allowed us to set the base for continued earnings resilience as we enter the development phase of our real estate strategy. Now, importantly, going forward, and probably even most relevant, our capital will serve as a key enabler of our future growth. Now, of course, technology continues to be a consistent feature of our evolution. We'll continue with the upgrade of our core system and ensuring that the investments in technology elsewhere in the group have seamless utility for Barita and its customers as we look to permeate that digital-first posture throughout the group. Now, again, the tech implementation will go at different speeds throughout the group, but are intended to converge towards that same ideal. So, when you think about the group, there are a couple of things, as I mentioned in previous meetings, that will define our group. When you think of our group, think of innovation, think of risk management and capacity, think of customer centricity. Now, innovation, as we look to organize ourselves deliberately to structurally deliver on continuous improvement and proactively meet the needs of our clients while we optimize efficiency. Now, the tendency is to think about innovation just in terms of cutting-edge technology, and for sure that will be there. But it also includes everyday gains from just a consistent review of processes and institutionalization of continuous improvement, really effectively challenging the status quo. In terms of risk management, it's maintaining our financial resilience as we continue to maintain above average levels of capital and our operational resilience through our governance and control environment. While, of course, as I mentioned, using our risk capacity as a springboard for growth. And finally, organizing ourselves and our operations around our customers and taking deliberate steps to institutionalize those elements that will allow us to listen intently and respond to our customers and leverage our expertise and institutional capacity to exceed their expectations and ensure memorable interactions throughout our group. So, with that, I'll hand over to our host to take us through questions.
Great. Thank you very much, gentlemen, for taking us through those presentations. This is now my favorite part of the session, which is our Q&A. So we've been seeing a number of questions coming in, so thank you very much for submitting those. Before we start, just a quick reminder that if you do have any questions as we're going through Q&A, please do drop them in the box. It's not too late to submit your questions. All right, so let's kick off with a question from Mr. Burgess. How is your pipeline of public equity and debt offerings looking for the next 6 to 9 months? And how do you think the local stock market will turn around? Ramon, you look like you're going to take that one.
Yeah, I suspect I have to take this one. So I can speak more generally, right? I mean, obviously, we're weary of making forward-looking statements. I can speak broadly. So I'll probably answer the last question first. So really, the outlook for equities, the equities market has been challenged for two main reasons. Higher interest rates tend to have an inverse correlation with equity markets. Fixed income type options become more appealing, and it is therefore challenging for investors to make that switch. So we have now an environment characterized by falling rates. We've already started to see a pickup in interest in the equities market. And that's been complemented by improving earnings, which is, of course, the main fundamental source of value from an equity perspective. So our outlook for the equity market is certainly improving. It's positive. We have been saying that the market is at a place where people should start to get selective and start to go shopping. We're still very much of that belief. Right? Now, to speak about the pipeline with respect to offerings, on the debt side, certainly there was a slowdown when rates started to go up, but we have seen a resurgence of debt capital market type transactions. Generally, and speaking retrospectively for Barita throughout our last financial year, we definitely saw a pickup relative to 2023. So the outlook there is positive as rates start to go down, right? People are going to want to proactively refinance debt that they took at higher rates. And people are now probably going to be looking at projects that they had sitting on, that they shelved, and said, okay, rates are now at a level that they can dive in. On the equity front, we have definitely seen a slowdown of new offers. Right. Last couple of years, we've probably had 2 IPOs on the Jamaica Stock Exchange. I believe a confluence of factors underlined by the shift in monetary policy and complemented by the fact that it was announced that we're expecting to see an uplift in the cap, and the fundraising cap on the junior market. I think those two things could probably be catalysts for an increased number of listings in a go-forward way, but we will see. But broadly, I'd say the outlook is certainly more positive than what's behind us in the recent past.
Thanks, Ramon. So this is from a different member of the audience, but probably somewhat of a follow-on. Asking, what is Barita's prediction for the economic climate for the next 4 years and beyond? This is probably like a 3-point question, so I'll read them off and I can repeat if necessary. So what is Barita's prediction for the economic climate for the next 4 years and beyond? And is there any private equity investments that Barita is involved with or planning to take on?
All right, so let me take that one as well. I was busy writing them down. Thought it was going to be a longer list, Karen.
There may be one more, but I was taking time.
No worries. So, read the prediction for the economy. I keep leaving my crystal ball when I come to these meetings, right? So, I don't quite have a prediction, but I can speak about what the past and the present is telling us, what policy is telling us, and 4 years is a long time, so I probably moderate the timeline to maybe the next 4 to 8 quarters. Right? So, from a local perspective, the government would have organized a policy address led by the Prime Minister and with support from the Finance Minister earlier this week, where it was announced that the government intends to move its fiscal policy direction deliberately towards growth. Right? Now, the last 10 years or so have been characterized by unprecedented fiscal discipline, right? And that fiscal discipline has become entrenched both through it being expected practice and through a shift in policy and laws, right? Supporting the continuation of that fiscal discipline. The government has, however, announced an intention to deliberately facilitate and participate in targeted investments in key areas of the economy, with the objective of not only driving growth in the immediate term, but setting up an environment that supports sustainable growth over time. That in and of itself serves to do two things. One, the tangible output that could come from that would certainly be accretive to growth. And complementing that, the confidence that it could bring and the co-investment that it could bring from private sector and from overseas could also be a catalyst for growth. And so, that factor in and of itself is certainly very positive. Now, if we look at what has been built to date, we have an economic environment with low and falling debt, relatively speaking. Our debt to GDP has halved in the last decade. We have inflation that's under control. We have a credit rating that has risen several notches in the said period that I just referenced. We have political stability. We've had examples of change of power and so on. So Jamaica is probably as ripe for investment as it has been in the last many decades. Right? That is also complementary to a potential positive outlook for growth. Barring a serious fallout in the global environment, Jamaica is still a small, open, developing nation. I'd say the outlook for growth in Jamaica is one that is at least incrementally above what we would have seen in the recent past, with fiscal policy being steered in that direction, with monetary policy through inflation targeting being accommodative or moving to being accommodative, with a very strong, capable and private sector whose confidence should be increasing on the back of this, and with an investment picture that looks quite attractive to the global investment landscape. I'd bet on more positive growth than we've seen historically. The second question relates to private equity. So, as I had mentioned and has been mentioned several times, that's certainly a part of how we view the universe of alternative investments. And we have made private equity type investments, over the last couple of years. One that I can speak about, for example, is that we would have made a private equity investment in a client of ours who would have brought public One Great Studios. From there, the investment was transitioned to being a public equity investment. So we do that from time to time, and we do have others. And as the operating environment shifts and more opportunities present, we'll certainly look constructively at them.
Thank you so much, Ramon. All right. So our next question, we seem to have a few clients online, is asking, how can I get the best returns from my investment? Dane, I'm going to ask you to take that one.
All right, thanks, Kerry. So I would, and thanks for that question, Sydney. So I'd answer that question a little bit differently, and speak about how you get the best outcomes from your investment. So I think, first it's useful to speak with your advisor, who can really look to tailor an investment program for you based on your own individual circumstances. They'll examine your risk appetite, any liquidity needs that you may have, and what your goals are, and pretty much from there, craft a portfolio specifically tailored to your needs. Now, what's important is that you get started, that you remain consistent, and that you remain invested. And our officers will navigate you through the changes, whether it be in terms of the investments that they manage on your behalf or working with you to navigate any changes that you yourself need to make to your investments. So I would say that's the best course of action, ensuring that you get started, remain consistent, and stay invested. And our officers are more than capable of guiding you through that.
Thanks, Dane. I think that's some great advice. All right, our next question notes that stock prices are high, and is there any plan to split the stocks so other investors can invest? I'm not quite sure if this is specific to Barita or the stock market, so maybe we can approach it from both angles.
Sure. Yes, I too am not quite sure. I mean, I can give a general answer. So a stock split is a mechanism used to reduce the nominal value of shares. As the question would have implied, it tends to be a tool used when the nominal value of shares rise to a level that's probably prohibitive to smaller investors. In Barita's case, we're trading in the $70+ range. And the JSE has, over the last couple of years, reduced the minimum volume to be traded by an investor. And I think single-digit units can trade now. So I wouldn't quite say that our stock price is at a level that's prohibitive, even to some of the smallest investors on the stock market. Looking across the market, there are many stocks that are traded in triple digits. So it's not. I wouldn't say it's something that's heavily on the minds of most companies on the exchange at the moment.
Thank you, Ramon. All right, one more question. Will there be any direct access to any international investment vehicles like ETFs and index funds?
I'll take that one again. So the short answer is there is already direct access to these vehicles, but the challenge has been, to be very frank, the cost associated with accessing it and the efficiency surrounding it. I can tell you that we have not yet to presently found the most efficient solution for clients who are best placed and most focused on those markets to allow for consistent investment in single names on the global equity market. Right? Consequently, what we have presented as our primary solution in that space is our FX Growth Portfolio Unit Trust Fund. That fund invests in the said global equity market, and that fund is actually up over 40% over the last year or so. And our investors in that fund have obviously enjoyed those returns as well as a diversified exposure to that market. So that has tended to be our preferred solution, just to be very transparent for people who are looking to invest in the international equity market.
Thanks, Rahman. It seems you shouldn't get too comfortable sitting back in your chair. All right. So we have a question in regards to policy stance. So given the shift in policy stance of BOJ towards cutting rates, is the company exploring greater leverage if the cost of debt continues to decline?
All right, I'm getting all the right questions today. So the short answer is yes, and then I'm going to explain why. So I mentioned during my section of the presentation that we set about a very hard task of serially raising equity capital between 2019 and 2021, right? And cost of debt was super low then, right? Now, what that did is that it put us in a very different position from our counterparts and a very different position from what typical securities dealers or investment banks tend to be in, where we were overweight in equity capital, right? We continue to be overweight in equity capital, relatively speaking. Stephen spoke to the fact that our capital ratios remain above the average for the industry. And while that's great from a risk management perspective, it could also imply that there is room for us to allocate and utilize some of that capacity with the objective of generating more returns. When you look at the components that produce our return on equity, if you were to break it down, right, and return on equity is a pretty good measure or benchmark to see how a company is doing. It's broken down into three components: profit margin, leverage, and asset turnover. On the profit margin front, we're pretty competitive. Asset turnover, great. But with respect to leverage, we tend to be below our peers in relation to that. So it means that there is room for us to potentially grow our leverage, especially as was said in this lower interest rate environment. What's also appealing to us about potentially going to the market for debt, which is an option that is always available to us, is that it could give us an opportunity to diversify the liability side of our book away from existing sources. So that's another potential point of appeal. So the short answer is it's certainly something that we continue to look at constructively.
Thank you very much. All right, now Barita has been in the press quite a bit recently. So we have a question that asks, would like to find out if any potential negative impact has been eliminated with an end to the recent legal issues in the courts.
All right, I'll take that. So how I respond to that is this. We understand that our stakeholders and clients would have been as invested as we were in this matter, and of course, a resolution of that matter. And we're definitely happy that this long-standing matter has been resolved and that we're now able to fully focus on the normal course of our business, being a lot sure-footed with our strategy and really serving our stakeholders and our customers with the highest level of integrity and business acumen. Now, of course, we're bounded by the advice of our legal team and what we're able to disclose, which for now is limited to the statement that would have been issued by the Committee of Management of Rita Humphreys Lewin, which have been published in the newspaper, which withdraws and shows regret for the allegations of wrongdoing against Cornerstone and Barita and its officers, Mr. Paul Simpson and Mr. Jason Chambers.
Thank you very much, Dane. All right, so one of our audience members is asking if our reorganization process will indeed commence in March of 2025.
Well, the process of the reorganization would have already started. So various elements of the process we would have gone to the court to obtain approval for the convening of shareholder meetings. So as I telegraphed earlier, we're far advanced in that. We expect to convene those shareholder meetings early next year, and expect that the reorganization will be complete early in the next calendar year as well.
Thanks, Dan. So we have a question that I quite like, asking, how does Barita stack up against all the other financial investment firms? Ramon, you want to take that one as CEO?
Sure. I'll try and be as objective as possible. Right? So I think I've answered some version of this question in this setting before. So I'll try and focus more on actual aspects of our business, because of course I'm going to tell you that Barita is fantastic, right? And we're where your money needs to be as we make money work for you. Right? But I'd say, if you think about products, we generally offer the same kinds of products as the rest of the market. How I think we differentiate ourselves with respect to, for example, some of our investment products is performance. If you think about our unit trust funds, over the last 6 years post-acquisition, for three or four, at least 3 of those years, we've had the best performing unit trust fund in Jamaica, right? Which means that we're consistent as it relates to performance. With respect to our investment banking business, which is an infant by all definitions, it's 6 years old, but we have really focused our attention on being a little bit out of the box. We are very proud of having been able to complete during the last 6 years some really landmark transactions. We've done the largest additional public offering on the GSE. We've done the largest capital raise on the junior market. We have done some seriously unique transaction forms, cross-border transactions, which have stretched the bounds of our ingenuity as an entity. And, we think that is, while not a feature that is specific only to us, we think that that's certainly a redeeming quality and something that we bring to the table for our clients, for sure, right? When we think about our brokerage business, we have grown in our capability there as well, right? So in 2018 or so, when we just acquired the business, we were probably 5th or 6th largest broker in terms of value. And last year, we were the largest broker by value trading on the Jamaica Stock Exchange again. So we're capable in that space if we're looking at that metric. We spoke earlier about indicators of risk management and risk capacity. Our capital ratios are really high, well above regulatory standards, north of 25% on the capital to total asset, to capital to risk-weighted asset ratio, which is well above the regulatory minimum of 10%. So you're talking about a large buffer of capital to withstand shocks. That's important to know that the financial institution that you're doing business with can manage a bump in the road. Right? We definitely have built capacity to be able to manage many a bump in the road, which I think is another differentiating factor. The final thing, which is more intangible, is that we really pride ourselves on having constructed an excellent team of persons, right? A diverse team of persons who have brought a wealth of experience, many relationships to bear in the business over the last several years. And given when and how we've been able to build that team, we think we've gotten a lot of the best of the bunch that there is to offer. So those are just some things that I'd put forward. I'd invite the person who asked the question to become a client if they're not one again, and give us a chance to show you what's different about us.
Thanks, Ramon. All right, so our next question is, with significant increase in ECL expense in 2024 compared to a reversal last year, does management foresee further deterioration? And I think I'll throw that question over to Stephen.
Sure. Thank you for that one, Kerry. So there are really two components of what goes into your ECL calculation. From one perspective, you can think of it as those that pertain to the environment, and then those that pertain to specific credits. Specific credits, it's not possible to predict how that's going to unfold, but the environment that we're seeing, where we're seeing more accommodative, less tight monetary policy, that would tend to reduce the type of stress that often leads to worsening credit conditions and therefore higher provisioning. Also, the lowering of interest rates, again, that tends to ease the burden that fall upon entities that have significant debt, and therefore also tends to reduce the need for ECL provisioning or the pace at which you'll tend to see an increase. That said, it's always going to be subject to the mix that's within the portfolio, as well as the situations with individual credits, particularly those that are larger within the portfolio and therefore more material to the overall total.
Thank you very much, Stephen. All right, we have had a number of questions today, so I'd really like to thank our audience for the engagement. It has been great spending this time with you and getting to answer your questions. I think we've just about come to the end of our time. I know there are a few, questions just generally about how to invest with us. So I just want to direct you to our website at barita.com. You'll be able to get assistance there. You can call us, email us, visit us in branch, and we'll be happy to assist you on your investment journey. So, ladies and gentlemen, again, thank you so much for spending your afternoon with us. It really has been a great pleasure. We hope that you have gotten great information and insights from our Barita Beat segments, which of course is where we get to share our financial updates with you on a quarterly basis. So we look forward to seeing you for the next one. It's a very exciting time for us as we are in the first quarter of our new financial year. So please, keep engaged with us and look out for the invitation on when the next one should be hosted. So I just want to wish you all a great afternoon. I'd like to thank my co-hosts for sharing the presentations with us. We look forward to seeing you again soon. Thank you.